are you planning for an SME IPO in the next 3 years? And how should you basically review your business from a profitable business model perspective, probably to make a profitable growth story. Now, SME IPO is a very far-fetched thought, but to be able to go anywhere as far as business is concerned, number one, you should basically first have a business model which is scalable. Now, once you have a business model, everything basically starts with finance or start with basically a business finance function, and it ends with business finance function, because as I've been coaching everyone that everything starts with the financial planning or the setting up the business budget or setting up the business model or setting up the business forecast. Then it gets disseminated to the respective functional owners and the business owners. After that, when you measure the actuals, it is actually getting measured against the business objectives what you had laid down, and that is also being done by finance. Now, from a IPO perspective and from a visibility perspective, which are the core numbers that need to be measured? If I ask you, in any business, are profits equal to cash? What is your answer? Profits are never equal to cash. For example, revenue probably is sanity, profit is vanity, cash is reality. This realization needs to come. Sanity, vanity, reality. Cash is a reality. Every business that you do, ultimately, if it doesn't translate into the cash, then you have not done a business model which is profitable, a business model which is cash generating. That is something what you need to realize at the highest level. Now, to achieve this, one of the core business objectives that you should have as a business owner is monitoring the right set of numbers. Now, when I say monitoring the right set of numbers, what does it mean? Okay, in any business, you should have a mechanism to track your numbers on a regular basis. Now, when I say regular basis, if not daily, if not fortnightly, at least it has to be done on a monthly basis. Now, the question as a business owner, what all of you should ask me, or as a CFO of any organization, you should ask me, which set of numbers is to be measured. Majority of the CFOs would already know this, but people who are generally the business owners, they probably are not very familiar that what are the key levers of their business. So one of the core levers, what you need to track when you're planning for an IPO, right, is basically the EBITDA margin. Now, EBITDA means earnings before interest, tax, depreciation, and amortization, right? It's a number which comes after reducing all of your cost, but before your interest cost and depreciation cost, because that is a cash profit is what people call. Now, I'm sorry, it's very important for all of us to understand this key metric, because it simplifies performance evaluation and it allows for comparability between companies. It aids in valuation and it indicates the cash flow and growth potential and assess the debt servicing capability. What does it mean? If my EBITDA margins are high, then naturally I'm talking about a higher profitability, higher valuation. Because if you look at the valuation market in the entire globe, everything is backed up by a PE multiple, or people call EBITDA multiple, or they call it as a revenue multiple. Now, when you talk about EBITDA multiple, more and more your EBITDA is, the multiples also will be larger and the valuation will be more. And that's the reason depreciation and interest is a non-cash item and EBITDA is basically a cash profit. And that's the reason the valuation is always on cash profit. It doesn't matter what your PBT is. It always matters what your EBITDA is. Second most important numbers from a business model perspective, everything, for example, what you do, if you're a manufacturing business and if you're selling it to several sectors, then you need to track your business through your industry to whom you're manufacturing and supplying. If you're a service industry and if you're developing certain app, or if you have a headcount driven model, then your customers will have to be segregated based on industry. For example, you will have customers in BPO industry, you will have customers in pharmaceutical industry, and it is quite possible that a pharma industry is probably more profitable for you as compared to a manufacturing industry. Now, for that reason, what do? You basically look at your segments. What are the segments of a business? For example, a business which has got multiple product lines, like you have 50 products. Products become your segment. Suppose if you're doing services, then logically, to whom are you selling? Those category of customers becomes your segments, and basically what you're giving it to them in terms of services also become your secondary segment in terms of services. If you're doing, say, an IT service business, and if you're doing product engineering, you're doing service engineering, and basically you're doing also PLM implementation. Then these three becomes your service line based on which you will measure the profitability, that which is the kind of service that is most profitable to me and where is it sold. It can be sold to a manufacturing industry also, like a Godrej and Boyes. It can be basically sold to a service sector also, like a BFSI and banks. It can be sold to a pharmaceutical sector also, like a simple IT services. So you will see which industry is more profitable, which service line is more profitable. That is the way majority of the service business measures their business productivity and business performance. This is basically known as a segmental level profitability, right? Which is one of the most important metric in any business. It provides insights into the business performance, growth opportunities, risk assessment, strategic decision making, and enhances investor confidence. Now, we are probably working with more than 50 companies, which are typically SMEs, small and medium businesses. Now, everywhere, it's a myth that basically you do the business as is, but our assessment and our ideology is very simple. Without measuring the business at a segment level, you will never be able to evaluate that which segment is performing, which segment is non performing, where is the action to be taken. And that is what we advocate in any business. Without segment profitability, your analysis is completely incomplete. The third and the most important lever of any business is GP. What is GP? Gross profit? That what you sell, and against to sell that, what is the cost that you need to incur? I'm not talking about a fixed cost. I'm not talking about a salary cost. I'm not talking about electricity. I'm not talking about rent. GP is very important because higher the GP, you will be able to absorb the fixed cost and you will be able to play with your pricing. If your GP is probably not in the right path, then you will always be a loss making company. When I say this, for example, if you're at a 15% GP, if you are making a sale of 100 and if you are at a GP of only 15%, that means you are able to generate only 15 rupees out of your business and your fixed overhead itself is 18 rupees per annum, then you will be able to make a loss of 3 rupees, which is not sustainable. So somewhere, either your pricing is incorrect or your raw material prices are incorrect. Your COGS is probably not right. When you say not right, you need to change that in some form. Either you have to negotiate with vendors or you have to basically negotiate with customers in terms of pricing. These are very important parameters what you need to measure in terms of the business profitability, in terms of business performance. In any business, you take manufacturing, you take service, you take trading, you take pharmaceutical, you take basically any IT services, you take any business. These parameters in terms of gross margins. In service business, you say gross margins. In manufacturing, you say gross profit or trading profit, right? What you manufacture, what you sell. To sell that, what are the kind of cost that is required? It gives you gross margin. After that, you take the fixed cost and you see what is the kind of EBITDA that you make. And after EBITDA is what you get depreciation and interest, and after that you get PBT. Now, when I say gross margin, the day when your gross margin is negative, the day when your gross margin is negative, that is an indication for you that you're doing something miserably wrong in your business. Your GP cannot be negative, right? And I have seen businesses where your gross profits have been negative, and I have suggested a very simple thing that you should take Godrej lock and you should lock your business clearly. And I don't shy away from saying this because this is something what every business owner needs to practice, every business owner needs to implement, every business owner needs to advocate to each other that gross margins cannot be negative. Fourth and the most important performance parameter is sensitivity analysis, right? It evaluates risk. It basically supports scenario planning. It adjusts the valuation. It again aids decision making, and it again enhances investor confidence. When I take sensitivity analysis, if you're doing imports, if you're procuring from the international market and selling in the domestic market and vice versa, then you need to hedge against the foreign currency risk. When I talk about sensitivity, if today you are selling in the domestic market and you're probably importing all the raw materials, and if the dollar prices probably go from 80 to 85, what you will see, you will not be able to pass on the exchange risk to your customers. You'll purchase it at 85 rupee to dollar, which is pegged, and you'll be able to sell in the domestic market at a much cheaper rate. That situation is not acceptable. So that is the reason sensitivity analysis plays an important role in every business, right? If my pricing changes from this to this, what is the impact? If my gross margin changes from this to this, what is the impact? That's the kind of simulation what you need to prepare in every business. Next important parameter, you need to have your budgets in place. When I say you need to have your budgets in place, budget basically gives you a benchmark, budget gives you a direction that in which direction you need to run, and budget gives you a visibility that where I need to run. You consolidate. When it comes to budget, you might be doing 10 things. When you actually prepare a budget, you will realize that 6 places is where I am only diverting my time without any profitability, and 4 places is where I need to consolidate. I did it for my own company. Okay, I was dealing in 9 to 10 business verticals, and over a period of time, I realized that there are only 4 business verticals what I need to operate in. And today, if you talk about Contetra, I have 3 business core verticals, and fourth one is all that we are exploring, and everything else is ancillary. When I say ancillary, I don't run behind those numbers consciously. It comes to me as a service organization. But if I talk about my core verticals, it's only 3. So I practice what I preach. So consolidation is very important, and budget basically helps you to do that, right? So YOY budget variance analysis is definitely essential for setting up the performance evaluation, for setting up the financial control, for setting up the cost management, okay, for basically making sure that the forecast is accurate, and investor transparency. It also helps with financial performance assessment, accountability, variance analysis, and improved financial planning. This is one of the most important exercise, because budget, the more granular you go into budget, the more clarity you get in your business and the business model, right? You need to go at a segment level. You need to look at what kind of fixed cost I have. You need to look at what kind of segment profitability I'm making, and accordingly make your budget. So budget activity is very important for all of us. Now, another important parameter, majority of the business owners, okay, to save taxes, we have a lot of adjustments, and I am saying it in the open LinkedIn. Okay, one needs to really know what is your true cost, right? When I say your true cost, it is important for an accurate valuation in terms of assessing what is your true cost. Don't look at the cost from your profitability perspective, what you show for the purpose of paying taxes, probably. Look at the real cost, what you are incurring in the business, and accordingly plan. Okay? I have given a lot of actions behind these words when I talk about the true cost. Okay, think about it, and basically it gives a lot of impactful analysis to you in terms of profitability assessment, financial planning, and it also gives you a visibility on risk mitigation, that what is the kind of risk that you're setting on. And the most important parameter in terms of measuring your business performance is basically ROI. Everything that you do in a business should be measured based on ROI. Every cost that you incur should be based on ROI. That what is the business case? If you're incurring, say, 100 crores, what is the X that you're expecting? And that is what is the valuation game also. Now, there are probably 4 stages in any business. It's profits, cash, value, valuation. First, focus on building profits, then focus on building cash, then focus on building value, right? Because if you don't have cash, you will not be able to survive. Cash basically helps you to survive. Profits help you to basically build a sustainable business model. Value, any business needs to have value in order to build the valuation. That is a game of valuation, what all of you need to understand, right? ROI basically is an important parameter for attracting investors, because that is what the investors look at. It gives you a benchmarking, right? For example, every investor is probably end of the day interested in knowing what is the money that you're putting and against that what you're getting, right? So there are some of the important parameters or key. At Contetra, we say that there are 7 levers, which is very important when it comes to business measurement from an IPO perspective. That the first one is basically the sales, second one is COGS, third one is gross margin, right? Fourth one is operating EBITDA, fifth one is inventory turnover, inventory management, at what level you are maintaining your inventory, because lesser the inventory days, more will be the cash that you will be able to generate out of your business. Sixth lever is basically debtors turnover. Within how many days you are able to collect your money? DSO, day sales outstanding, which is one of the most important parameter, right? Lesser the DSO, more will be the cash that is converted out of your business cycle. And seventh, and the most important lever, is creditors management, creditors turnover. Within how many days you pay your creditors? Don't make yourself proud that I'm able to delay my creditors payment. Your delayed creditors payment directly impacts your operating cycle, and they don't supply the raw materials on time, as a result of which there is a significant delay in your basically production, and which basically in turn delays the sales cycle entirely. It's a vicious cycle which one needs to understand. At Contetra, so we are working with almost more than, as I told you, 100 business owners over the span of last probably 5 to 6 months. Now, if you are a business owner who is looking for an SME IPO in the next 3 years, and if you're not tracking these important metrics, which is very important in order to go for an IPO, and any investors will look at it, and if you want to need help in setting up the systems and process to basically automate this tracking, and if you are someone who is very much interested in doing a performance monitoring of your business, right, then get in touch with us. You can definitely set up a non-chargeable business review call with our team of strategic consultants to know more about how we can help us. Thank you.